Good afternoon and welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me live at MarketSite is Matthew Bartolini. He's the head of SPDR Americas Research at State Street Global Advisor, and we're here to discuss tax reform, which is really the hot topic for traders going into the end of the year. Matthew, thank you so much for joining us over at MarketSite. Now, policy reform, particularly taxes, shift sentiment rather quickly, and we saw that in a couple of days of trading last week. What signals are you watching?
Yeah, so tax reform most likely will lead to a reflationary environment. So we're looking for more signals that would portend more cyclicality in the marketplace. So that's small caps over large caps, value over growth, high beta over low beta stocks. But it also has an impact on the yield curve. So we're watching break evens and the trends in the yield curve, which has continued to flatten pretty much over the past couple months.
Right, so what happens when it flattens or goes inverted? How does that impact the equity markets?
Well, the yield curve is essentially the assessment. So if you look at the 10 and 2-year spread, the 10-year should give some prospects of growth and inflation, which have been pretty mundane for the better part of a decade. While the 2-year is going to be impacted on what the Federal Reserve does. So the Fed has been increasing sort of the short end. Meanwhile, growth and inflation has kept the long end constrained. There's been a lot of research from the Cleveland Fed that shows that inverted or flattening yield curve does lead to a recession. At 60 basis points wide, we're still a decent way from there, but it's definitely something to watch because it's essentially the market's expectations of forward-looking growth.
Does it mirror other historical times in the market, the way the yield curve looks right now? Have we seen this type of before?
Well, in the last 3 recessions, you've had a flattening yield curve that then went inverted. Like I said, at 60 basis points now, you're still a little bit away from that, but it definitely gives you a sign of slower growth and lower inflation that has basically marked this entire bull market over the last 9 years.
All right, and outside of sentiment, how does tax reform impact earnings? Because they were pretty good for Q3 earnings this year.
Yeah, so tax reform should give this sort of reflationary boost to earnings, and you're starting to see some of that come through in analyst expectations. They're quite lofty. So in 2018 and 2019, it's expecting a 10% boost year over year. Put in 10% plus 2017, and that's 3 years of 10% plus growth, which hasn't happened since 2011. And that was back then when the Fed was doing QE. So you're seeing heightened expectations of sort of a fiscal stimulus boost. And what's happening is we're in this late cycle environment. Firms are getting punished more than average when they miss earnings expectations, and the ones that beat are not being rewarded as much. So we're actually looking environment and sectors that have a propensity to consistently outperform those expectations, because if they start to get lowered year over year, you want to find those firms that can jump over that bar.
It seems like there's been a lot of pent-up volatility, and we've seen that with Q3 earnings. For those that missed, they certainly felt it in terms of the downside. I think the question that traders have is we've seen such a run up in these stocks, 20, 30, 40%, and it hasn't been reflected in earnings. And with this big tax reform overhang, what happens if we don't get that passed for 2018, I think is really what the question is.
Yeah, I mean, so right now, basically forward-looking price to earnings estimates are elevated. They're about 20% above 25-year averages. Meanwhile, earnings growth expectations are quite lofty. So you kind of have to have something has to happen. Either the price will have to come down to reflect the lowered earnings estimates, or those earnings estimates will have to come through. But essentially, I think what you're saying is valuations are high, and if all of a sudden earnings growth slows, high valuations are not going to be the safety net that catches this market.
Do you think that investors have been too complacent, even with what the high yield market is showing us, or it's still a little bit early for that?
Yeah, so complacency is very high. So when we think about complacency, we look at things like, what is the VIX doing? So the VIX has basically spent more days below 10 than in any of the 26 years combined. So that's a quite low volatility anomaly. And you combine that with high price to earnings valuations, you basically have a market that's saying we'll pay high for next year's earnings because there's really no risk. That's complacency through and through. And this low volatility anomaly has actually spread across all other asset classes. So high yield, investment grade, bonds, oil, everything is sort of in that low 10th percentile from realized volatility over recent averages.
Well, another question that investors have as well, outside of the high yield market, where else are you generating income?
Yeah, that's a question we get a lot. And when we're looking at this, so high yield spreads are tight. And the sell-off last week was rather idiosyncratic if you look at the sector composition of telecom and retail. But still, spreads are tight, convexity is negative, which is not great for upside potential. So when we think about income generation, we're looking at senior loans. They sit higher in the capital structure. They have yields of around 4.5%, 5%. and they have that benefit of floating. So when the Fed does hike in December, like 90% believe they will, you should get a boost in income, getting yields go up higher. Meanwhile, since you're senior in the capital structure, you can mitigate some of that spread risk because you're not going to widen out as much.
Right. Well, all right. My question to you is to wrap it up then, based on what you said, what you're seeing in the high yield markets, does it look like it's more sector specific than broad market pressure?
Yeah, last week was definitely a little bit sector specific. I think there was also some spillover from the uncertainty around tax reform, so that's definitely something to watch for. I mean, looking ahead, while year end is coming, you have tax reform uncertainty, then you have a debt ceiling debate come December 8th. So that's not going to be really a great gift for Christmas if all of a sudden you have an unsettled tax reform debate, an unsettled debt ceiling debate, also a Fed in transition. So I think investors should look to the credit markets to see how risk is being priced.
All right. Well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me on Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq.